Are we gonna get 50 basis points, man? Not looking good. Oh man, so a new PCE inflation report has just sent shockwaves through the market. We missed across the board, and Bitcoin is falling 3.5%. The traditional markets falling as markets start to fear a more aggressive Fed in 2023. As you can see, core PCE inflation came in at 4.7% versus the consensus of 4.3%. If we take a look here, the PCE price index, excluding food and energy, increased 0.6% for the month and was up 4.7% from a year ago. Wall Street had been expecting 0.5 and 4.4% respectively, so you can see that is a major miss there. Core PCE gains were 0.4 and 4.6% in December, so this is just further backing up that January was a really hot month for inflation. But more importantly, what does this mean for the markets? You've seen Bitcoin fall 3.5% here. What are the price targets? Where can we find support? And what does this mean? If we take a look at the traditional markets, NASDAQ shedding 2%, S&P shedding 1.5%, and 1.25% almost here for the Dow Jones in the red. It has been a horribly hot January for inflation. That has been very, very clear from the CPI, from the PPI, and now to put the nail in the coffin, the PCE inflation report comes in super hot. And remember, this is the one that the Fed uses the most because it adjusts for consumer spending habits, such as substituting lower priced goods for more expensive ones. So this is a more realistic take for inflation that the Fed uses at the FOMC meetings. What have we noticed? We've noticed a big shift. And I've been talking about this, guys. We spoke about this after the CPI. We spoke about it after the PPI. And we spoke about it after the FOMC minutes. You've seen this percentage creeping up. You should have seen it coming. And now 33% of the market, that is not insignificant, is expecting 50 basis point at the next meeting. Now let's jump in and listen to some of the highlights from the president of the Fed, Mester, to see what she says.
I want to start off right away with where the market is right now. There has been a big move in interest rates. Yields are much higher now. So I guess my question to you is, do you see now, is there sufficient tightening in the market for the market to help the Fed affect its policy of cooling the economy and bringing down inflation?
Well, we always like to align, with where the markets are, and we don't want to surprise the markets. So the alignment, I think, is closer than it was before. But, we're going to set policy to do what we have to do to get back to price stability. So we've been raising interest rates. We've seen some of that working through the economy. We have seen some pressure off the inflation, but inflation remains too high. And as you know, coming out of the meeting last time, and the minutes showed earlier this week, that we're going to have to do a little more to get that back to price stability of 2%.
So I said yesterday, there's only one species of Fed official now, a greater or lesser hawk. Where do you put yourself in that, if at all? Are you on the high side when it comes to that average or median Fed funds forecast among Fed officials of 5 1/8, or are you higher or lower than that?
Yeah. So as I always said to you, I'd like to be known as an owl, not a hawk or a dove. But in any case,
for his wisdom.
Right, exactly. But it's not up to me to call myself that. I see a little more impetus in the inflation measures than my colleagues did, at least in December when we put out the last SEP readings, the Summary of Economic Projections. So I had my funds rate a little bit above the median in that projection, and I haven't really seen much change in my outlook for the economy since that time. So I see that we're going to have to bring interest rates above 5%. And we'll figure out how much above. That's going to depend on how the economy evolves over time. But I do think we need to be somewhat above 5% and hold there for a time in order to get inflation on that sustainable downward path to 2%.
But it's maybe significant. What you're saying is you haven't seen anything in the interim that causes you to change where your dot was in December.
No, I think I'm where I was because, remember, I saw a little bit stronger, more inflation impetus than the median did. And I also think that the labor markets, I'm not really seeing a trade-off between the hot labor market and inflation. I'm really focused on inflation. And what we learned over the last expansion, the pre-pandemic expansion, is that, the unemployment rate can be very low without necessarily spurring inflation. So I'm really focused on the inflation numbers. And I don't see that we have to have this trade-off necessarily between labor and price stability. In fact, I would say I'm greedy. I want to have healthy labor markets and a return to price.
My colleague Joe Kernan wants to ask you a question, but I want to just get one more before we get to him. The real question I want to ask you is what the heck's going on with the economy? We're supposed to be an economy that was right now either in recession or on the way to recession. We printed 500,000 jobs for January. We had retail sales go through the roof. Is this all seasonal adjustment? Is this economy weakening, or is it ignoring the Fed when it comes to higher rates?
No, I don't think it's ignoring. I mean, we've seen some of the impact of higher rates. Certainly, if you look at the housing market, right, that's definitely clearly slowing, right? Manufacturing slowed a bit. Now we have some impetus that suggests that maybe it's not slowing as fast as we thought. So, if you had to sort of characterize what's happened is coming into this year, there's probably a little bit more underlying strength than a lot of forecasters thought. But there's also some movement, good movement on the inflation measures. They are coming down. It's just that the level of inflation is still too high, which is why coming out of our last FOMC meeting, the broad, consensus was among all the participants was that we're going to have to do more, which is why the statement said ongoing increases.
So as you can see, there were some interesting points there from Mester. First of all, you noticed that she backtracked that at previous meetings she was a stark proponent of 50 basis points, but now she thinks 25 could be enough. So this is where things get quite interesting because the market is pricing in 25 basis points, but that 30% of the market we looked at, 33% of the market, is pricing in 50 basis points. So if we see 25 basis points at the next meeting, we could see this market starting to buy that dip and really starting to rally. So Fed Mester was further pushing in on the claims that this Phillips curve notion could be broken, which is that we need to kill employment, i.e. increase unemployment, in order to get rid of this inflation. You saw that from Jerome Powell as well. He said the disinflation process has started and that it was good to see the labor market remaining quite strong. They think they can bring inflation down without having to cause large amounts of unemployment, which is very interesting. It was interesting to see Mester say the same thing. She's a quite hawkish person, okay? So markets will be expecting that's a hawk. This could be quite bullish news. But with that being said, the market is not taking this so positively right now. But could this flip-flop? That is one of the things I'm looking out for right now is could we see a U-turn? Maybe even by the time I've uploaded this video. Could we see a U-turn where the market decides, hang on a second, are we getting upset about nothing? We knew January was going to be hot. We knew there was a bunch of seasonal adjustments. We saw that energy prices accounted for 2% of it and food with the other bit. Are we kind of over-egging this? And are we overreacting to this January read? Should we instead stay calm, let the Fed do 25 basis points, and then see what happens at the next set of CPI readings for February, the period which we're in? There's no point looking at old data. We already knew January was bad. We saw that with the CPI, we saw it with the PPI, and all the PCE did was affirm what we already know. So do we really need to dip again? So don't be surprised to see this dip starting to get bought. And when I look at Bitcoin here, yes, it's a big red candle today. This is proper red candle, not like the little ones we had in the previous days, 1%, 1.5%. This is a 3.5% down day today, and this is representative of a 2% down day in the Nasdaq. So we look at this on the daily chart, and now we're finally getting a proper pullback, right? Everybody's complaining over the last couple of days. I said, guys, that is not a proper pullback. Let it get into its EMA ribbon, let it come towards 22, the horizontal line from our channel, and then we're talking. By the way, if you want to learn how to do EMA ribbon, head and shoulders pattern, ball flags, I've got a step-by-step TA course which is completely free. Yep, not charging thousands of dollars for my course. Links in the description to Skillshare. Get yourself set up on there, watch through that TA course, and let me know if you have any questions. I am making new courses on fundamental analysis on chain. So if you already watched the TA one, make sure you keep watching it to make sure it sticks in your head, and then wait for the other ones to come out. They'll be free as well. So you're looking here at Bitcoin. We need to see this dip being bought. We need to see a higher low. Remember this low here turned around on the lowest part of this doji candle, which again, we go through the TA course, doji candle, you guys should be able to pick that up, is at 21,400. So we got to turn around before then. A nice level to turn around, but this is 22,000 level. It's the top of our channel. We've been in this channel for a very long time. We know that it's a support and resistance level. Can we bounce from there and get some sort of action like this? If we do that and create a higher high beyond there, that'll be a really nice, steady upwards trend we're forming here on Bitcoin. And for me, this would produce a nice opportunity to buy the dip. If we get close to that 22,000 mark, even 22,300, around this ribbon into the darker parts of the EMA ribbon, I will be looking for opportunities to accumulate. That being said, I've got to remind you guys of the situation we're in here on the weekly chart. And on the weekly chart, what have I always been mentioning here throughout this start to 2023? We've got to clear this weekly EMA ribbon. And surprise, surprise, not really. The bears are not giving this up without a fight. You can see the wicks on last week's candle. You can see the wicks on this week's candle. Where are they occurring? Right at the top here of that 25,300 level mark, which is right where we can reclaim that weekly EMA ribbon. And it's good. The bears are supposed to step up. I didn't just expect us just to run through here and keep having positive weeks. No. Look at these 2 weeks. They're negative weeks, and we came back with a strong week. Have a couple of negative weeks, and then Bitcoin can come back strongly, own this level, and then we mean business once we clear past this weekly EMA ribbon. But you have to pay respect to the bears. They can show strength on this level, so do not get yourself caught trading crazy leverage positions here. By the way, if you do want to trade, BYBIT, BitGet, those are 2 exchanges I use on a daily basis to trade. If you want to join me, click the links in the description, claim your unique bonuses, and definitely get yourself set up and practice trading with some lunch money. If you're new to trading, start with my TA course, ijaz.uk/TA. It's completely free. Get yourself set up on exchange, put $100 or something in there that you can practice with, some lunch money, stop buying yourself takeaways or fancy trainers, and learn how to trade. Right? It's so empowering when you can learn to, even if it's just like $30, $40, $50 you can make in a trade on a day. You don't need to make thousands of dollars a day to change your life. For many people, to be able to make $50 a day on command, sit there on their computer for an hour, trade, make $50, make $100, that can change your life. So definitely practice that skill. It's a very important skill to be able to trade. That's what we're seeing here play out on this chart. Now, what else are we noticing? Well, the first thing we need to look at is the dollar index. Remember, this dollar index is inversely correlated to crypto. When the dollar index has periods of downward time, crypto has benefited. It started falling here, we took our weekly EMA ribbon, and crypto did well. But look what you've seen here. 1, 2, 3, 4 weeks here of the dollar index rising. Not only is it rising, but look where it is right now. It is trying to close its weekly EMA ribbon bullish, and it's 6 hours away from doing so. If they get the close above here, this is going to be a problem. We need to drive this down. And all of this is on fears over the last 4 weeks that inflation is coming back with vengeance. It's entrenched. It's sticky. Markets are worried about that because that means the Fed could continue to keep hiking well into summer and towards the back end of this year. Whereas many people thought, oh, the Fed will be done by March. Don't worry. In fact, some people thought the Fed will be done by now. Crazy. I always said volatile Q1, Q2. And this could be dragging it into Q3, Q4 if we can't get control of inflation. But my view on it is I think the market is overreacting right now. I think they got to calm down. We see that January's a little bit hot. That can happen for a variety of reasons. We can see where those measures are. But just like Mester said, you need to look at the lead measures. All these figures we look at, CPI, PPI, PCE, they're all lag measures. They're looking 6 weeks behind almost at times. Right? And we know that interest rate hikes are lagging measures. It takes time before they take impact in the economy. So you've got to be looking at businesses. How are they finding it? Are financial conditions tightening? Are you finding it harder or easier to employ people? Are prices coming down? Ask those questions. Look at what businesses are doing. So this is a worry for me, this weekly dollar index curve. But look, this is crazy. 4 weeks. Okay, and again, look at that, guys. Doji candle. You would have spotted this reversal had you have watched my TA course. This indicates this reversal playing out. But I want to come back to Bitcoin. On those 4 weeks of the dollar index doing really well, 3 of those weeks have been bad here for Bitcoin. But look at this. Look at that positive week. So Bitcoin has had a decoupling over the last month here. Okay, Bitcoin has had a positive move despite the dollar index rising. The other thing to watch out for is this US 10-year yield. You've got to watch this. What is this forming here, guys? You can see this is forming the perfect double bottom pattern or a W pattern, which normally means it could go have a big move to the upside. This will be bad. If this can go and post a higher high above here, it can continue its upward trend with yields climbing back above that 4% mark into the 4.25, 4.3 levels, which is what we saw back in October. So this is something we want to watch here on the US 10-year yield because it is having another powerful week here, up 4% this week on the US 10-year yield. Why is this important? Again, the dollar index goes up and the US 10-year go up when risk rotates off. In order for Bitcoin to do well, in order for your altcoins to do well, you need risk on. We've not had our complete decoupling yet. We still have an element of correlation. We're just having moments of decoupling in crypto where crypto says, you know what, we've had enough of following NASDAQ, we've had enough of following the dollar index and the US 10-year yield. Sometimes we just want to move on our own. And you've seen insights of that, but that's not the trend just yet. We have to respect that over the last year and a half plus, we have been correlated to markets. So we can't just take that decoupling based on a couple of weeks. When we see it for months, then we can say, okay, Bitcoin's decoupling, it's doing its own thing right now. As you'd expect, many altcoins getting slammed here in this market. You've got Phantom down 5.7%, you've got BNB down 2.6%, Avalanche down 6%, Matic down 6% despite the popularity of layer 2s here over the last couple of weeks. Algorand down 5%, Cardano down 4.5%, Chainlink down 5%, 6.7% red day here for Polkadot. The one of the green ones is Optimism. Make sure you go watch my video from earlier today to understand why Optimism is up 7.68% on a day when Bitcoin is down 3.5%. And it's not just Optimism, guys. There are many other coins and many other narratives which could be running after Coinbase launched their very own layer 2 solution. In order to find out what those altcoins are, watch this video here and understand how you can profit from Coinbase launching their very own layer 2 scaling. Thanks for watching, guys, and I'll see you in the next one.